Finance with your host, Mr. Everett James. Hey, Ev,
Hey, Mr. Brown, how's my reception?
your exceptional reception is perfect, sir.
Thank you.
All right. Hey, what's on the agenda today?
Well, I want to, just finish the update, on the continuing resolution that was passed, uh, which is takes the place of the budget for fiscal 25 in the federal government, and then we're going to go into, some of the circumstances surrounding the final passage of the bill, and then look at what should be important priorities for taxpayers to stay abreast and adhere to the current requirements for April 15th, which is right around the corner.
Right around the corner. Okay, my friend, I'm gonna step aside and enjoy the show.
Okay, thank you so much, Mr. Brown, and welcome listening audience. This is Everett James, your trusty and reliable tax information reporter, coming to you every Wednesday morning at 10 a.m. on the West Coast and 1 p.m. on the East Coast. The effort here is to keep you updated and also to provide you with a platform to put some questions forward to the this program staff, and also maybe gain some beneficial free advice with no charge to you. So in that regard, please feel free to contact this reporter, Everett James, at 951-522-9877. That's 951-522-9877. And information will be repeated at the end of the show before signing off. For those who are more disposed to communicating via electronic modes, my email is evjtax1 at gmail.com. That's evjtax1 at gmail.com. Okay, so item number one, the government shutdown was averted. And it was really only averted because, of some incredible pressures that came to bear not only on the Republican side, but also on the Democratic side also. But about almost 2 weeks ago, March 15th, the Senate took up the bill that had been passed by the House of Representatives, and the Congress as a whole passed the full year continuing resolution bill. So it really wasn't, much of any kind of a novel or a very efficient approach to funding our government, but it did avert a government shutdown, and essentially just maintain the global health funding at prior years level. The president signed the 4-year continuing resolution on March 15th, and it does continue the funding through the end of this fiscal year, which ends September 30th of 2025. The this bill was quite an exercise. The House hardliners, Republican hardliners, were pushing for Mike Johnson to just ignore the District of Columbia's budget fix because apparently they were in nothing was done until the very last minute to fix that problem, that hole in the Washington D.C.'s budget. The the House Republican authored continuing resolution. It finally did clear the Senate a couple of weeks ago on Friday night. And as I mentioned, it did leave out some routine language allowing the Washington, D.C.'s government to continue raising and spending local funds under its most recent budget. Well, the District of Columbia financial advisors warned that a major emission had been allowed, which would blow a $1 billion hole in the city's budget. Collins and a couple of senators, Collins and Senator Chris Van Hollen, a Democrat from Maryland, crafted a 3-page measure to correct this omission. They mentioned that if they had allowed this mistake to take place, District of Columbia would have to wall off the law, enforcers. They have to close schools. They have to shut down trash removal. For those in the region who use Metro, they wouldn't be able to get back and forth to work. But in any case, that was corrected. So they did. One does notice that the House GOP leadership really did not really address the matter before passing their funding bill a couple of weeks ago to keep federal cash flowing through September. So in any case, the Senate did pass that 7-month funding patch just in time to avoid a government shutdown. This was a major victory for President Donald Trump and the Republicans controlling Congress. And it also caused a deep, deep rift in the Democratic Party that could be exceedingly difficult, from what they say, to repair. The Senate voted 54-46 on the House-passed bill. And of course, it was almost entirely along party lines. There were some exceptions to the rule. Democratic Senator Jeanne Shaheen of New Hampshire and Senator Angus King of Maine, who's an independent who caucuses with the Democrats, they voted yes, while Senator Rand Paul, a Republican from Kentucky, he voted no. So the stopgap measure would fund government operations through the remainder of this fiscal year. It interestingly will cut non-defense spending by roughly $13 billion, and then on the other hand, increase defense spending by about $6 billion over current budgets. And that included in that defense spending was billions for deportations, for veterans' health care, and the military. Of course, the Democrats opposed the measure initially due to the non-defense cuts, but also because Republicans refused to include language in the bill, putting guardrails on Trump and Elon Musk's ability to continue dismantling the federal bureaucracy unchecked. They had advocated for a shorter 4-week stopgap to keep the government funding running on current funding levels. That was just an effort to buy more time for appropriators to strike a deal on bipartisan funding packages. And Democrats spent days agonizing over how to manage the politics of the moment. But it did come after an extraordinary turn of events where Republicans in the House overwhelmingly passed the stopgap earlier that week without needing any Democratic votes at all. And then they left town for a recess. So it left the Senate Democrats with no choice but just to stand their ground against the GOP or force a shutdown. Since 8 Democratic votes in the chamber would be necessary to move the legislation over a procedural hurdle that required a 60-vote threshold. The vote on the final passage, it only required a simple majority. And at that point, it was just, really just nothing more than symbolic for the members of the minority party. It was reported that President Donald Trump did endorse the bill. So they did free up, $1 billion to fix that Washington, D.C. budget. And it did have a few interesting, inclusions in the bill. Of course, the minority leader, Chuck Schumer, gave a speech afterward, and he said he would vote to advance that GOP written stopgap measure. He called the Republican spending bill very bad, but he did argue the potential for a shutdown has consequences for America that are much, much more worse. And he didn't want to empower the president and Elon Musk to further gut federal agencies. One of the more interesting parts of the final bill, it did include a crypto bill. The Senate, this took place after the funding measure was passed, but the banking committee in the Senate approved digital assets legislation that would create a regulatory structure for stable coins, marking the first time the Senate panic had ever advanced major crypto legislation. It's really one of the Congress's most significant steps yet in the financial area, and not the budget area, but it's one of the Congress's most significant steps yet. It gives the crypto sector a long sought-after stamp of legitimacy that could turbocharge its growth. Keep in mind that I'm speaking about crypto bills and crypto growth, not the CBDC, central bank digital digital currency. That CBDC advances may have been very successful overseas, but still not here in the United States. Still here in the United States. It's been banned by legislation and also by the president. But crypto activity has obtained considerable support from the government. So they did approve that type of digital asset, that type of digital structure for stable coins. And it was, as I say, is one of Congress's most significant steps yet toward giving the crypto sector a stamp of legitimacy that could turbocharge its growth. 5 Democrats voted for the legislation, but there was and that was even though it was led by Republicans, there was strong opposition from the top Democrat on the banking panel, Senator Elizabeth Warren. So so we will keep you up to date. As we have promised, we will keep you up to date on any additional amendments to the bill that at least keeps the government open till the end of this fiscal year, September 30th of 2025. Okay, there's been a great deal of fear mongering, you might say, along with some very pungent and and comments that do have some truth in the warnings, and that is the cutbacks for some of the social services financial programs federally. One that I'd like to share an article, a couple articles with you again, and it has to do with the fact that there's been a great deal of advertising and a lot of opposition to any cutbacks in the Medicaid program, the major medical program for the United States. And to discuss that, I share with you a couple of articles from the San Bernardino Sun. First article that was authored by Susan Shelley back on January 7th of last year, of 2024. And it's entitled, "Can We Afford Health Care for Undocumented Immigrants?" Well, California is now providing the full scope of Medi-Cal benefits to undocumented immigrants. Woo! What is full scope Medi-Cal? Well, full scope Medi-Cal, it's called Medicaid in other states other than California. But when I mentioned Medi-Cal, I'm referring to the Medicaid program, but it's just, as I say, that's what it's called in California. But full scope Medi-Cal covers primary and preventive care, specialists, prescription drugs, and other services. Now, previously, immigrants without legal status, were eligible only for restricted scope Medi-Cal. What did restricted scope Medi-Cal provide? That provided benefits, for such things as an emergency room visits and pregnancy-related care. That does seem to be a pretty relevant and understandable extension of the Medi-Cal, Medicaid benefit program. But effective January 1st of last year, the California, the legislature in California went all out, and they all of the California residents who met the income eligibility requirements, regardless of immigration status, became eligible for the full scope Medi-Cal benefits. And how did that happen? It was advanced piecemeal. Beginning in 2016, full scope Medi-Cal benefits were granted to children under the age of 19, regardless of immigration status. Okay, just as long as they met the other eligibility criteria. That the scope of the services was then expanded to young adults through age 25 in 2020. So first, in 2020, it was expanded to young adults through age 25. Then 2 years later, the policy was expanded. This is in California now. 2 years later, the policy was expanded again to include anyone age 50 or older. And then again on now January 1st of this year, 2025, what happened? The um, here the on January 1st of this year, the missing group, adults aged 26 through 29, then they became entitled to exactly the same full scope Medi-Cal benefits available to low-income citizens and legal residents of California. So now there are in California approximately 14 million people, roughly one third of California's population, on Medi-Cal. State officials said the latest edition could add another 700,000 people to the rolls and will cost about $3.1 billion per year. You know, in truth, no one has any idea how many people will be added to the rolls or what it will cost. Medi-Cal or Medicaid in other states other than California is an entitlement program. Anyone who meets the eligibility requirement is entitled to enroll it in. And then they're entitled to have Medi-Cal, Medicaid in other than California states. Then they're entitled to have Medi-Cal cover the cost of whatever medical services they need. The latest expansion, was approved by lawmakers in 2022 and then tucked into SB 184, one of those lengthy budget trailer bills that are rushed through the California legislature in a matter of days without going through the usual committee process where policies can be more thoroughly considered. If lawmakers had taken the time to read the bill, there's a sentence there that might have jumped out at them. The federal Medicaid program prohibits payments to a state for medical assistance furnished to an alien who is not lawfully admitted for permanent residence or otherwise permanently residing in the United States under color of law. To repeat, the federal Medicaid program prohibits payment to a state for medical assistance furnished to an alien who is not lawfully admitted for permanent residence or otherwise residing in the United States under color of law. Now, what does that mean? That means California will not receive federal matching funds to help pay for the extension of full scope Medicaid or Medi-Cal benefits to undocumented aliens. So who's bearing the cost of all of this new entitlement funding? Well, guess what? It's on the California taxpayers. Now, the highest costs, of course, are going to be borne by Californians who already depend on Medi-Cal for health care. Politicians can stand up there pompously in front of cameras and declare health care is a human right. Well, that's not exactly the case because healthcare is a service provided by skilled and trained people. There just can't be a right to anything that has to be provided or funded by somebody else. To stretch the state's funds while enrolling more people to receive benefits, California is currently limiting the amount that healthcare providers will be paid for in treating Medi-Cal patients. And as a result, doctors have been for years and for decades now, they've been sharply limiting the number of Medi-Cal patients they would just accept. So the Medi-Cal reimbursement, reimburses providers at roughly 70% of the rate that Medicare pays, and Medicare pays far less. Medicare rather pays far less than employer-paid health insurance. So in 2015, groups representing California's Latinos filed a civil rights complaint with the U.S. Department of Human Services alleging that long wait times for care had resulted in lower survival rates for cancer patients on Medi-Cal. Then in 2017, the Mexican American Legal Defense and Educational Fund sued the California Department of Healthcare Services. The complaint stated that Medi-Cal reimbursements were among the lowest in the nation, causing Medi-Cal patients to have substantially worse access to healthcare than Californians who had different insurances. So the other data have shown that between 2000 and 2016, the percentage of Medi-Cal recipients who were new to the country, at the same time, those percentages of Medi-Cal recipients skyrocketed. In 2017, there were only 13 million Californians on Medi-Cal. Now it's 14 million on Medi-Cal, and there's an estimated 700,000 more eligible to enroll as a result of the latest expansion. But, is it 700,000 or will it even be more? While Biden was in office, Director of Homeland Security Alejandro Mayorkas admitted it was well more than 1 million per year. That's as far as there were a number of border crossings, and that was has hit some all-time highs. But the number of folks who immediately enrolled in the Medi-Cal or applied for Medi-Cal and who were receiving benefits, there's no wonder that California is now currently facing a $68 billion budget, shortfall. So if any of you in the listening audience would like to express your opinion, you may by calling the legislature, because they're attempting to pass a wealth bill that would allow the legislature to define wealth and then tax it. And the chairman of this effort is Joaquin Iron, IRWIN at 916-319-2042. Let her know what you think. Area code 916-319-2042. Okay, the second article that I'd like to bring to your attention was published March 16th, just March 16th of this just a few weeks ago, a couple of weeks ago, basically. And it was another article by Susan Shelley, indicating that the Newsom administration really just informed the legislature that now it needs to borrow $3.5 billion to pay unexpectedly high costs for Medi-Cal, and that's the state's safety net health insurance program for low-income residents that's now open to all undocumented immigrants. And that, I'm certain, is duplicated in other states of the union. It's probably more has been more it has been risen at a higher rate in California than in some other states. But other states are also being afflicted by this huge increase in their deficit in order to take on the health needs of people who have come to this country illegally. As of January 1st of 2024, everyone in California who is in the country, who was in the country illegally, has become entitled to full scope Medi-Cal. What is full scope Medi-Cal? Full scope Medi-Cal is unlimited, unrestricted, full free health insurance, as long as their reported income is low enough to be eligible. But wait a minute, there's more. Generally, California can seek reimbursement from the federal government for half of its Medi-Cal expenses. Well, that's not the case now. The federal law forbids reimbursement for care, provided to illegal immigrants, other than limited services available to everyone under Medicaid, also known as restricted scope Medicaid. In California, the Medicaid program is called Medi-Cal, and I think I pointed that out before. What's Medi-Cal is Medicaid in other states. So this situation is not only unfair to residents who are low income and who need the benefits of Medi-Cal. It's not really unfair to citizens because of the fact that their treatment is being cut back in a huge way because of doctors limiting the scope of their services and taking fewer and fewer Medi-Cal patients over time. So, I mean, it's really a sad situation. Okay, folks, what we will do now is to get into some of the specifics, of the current demand by the federal government and IRS for completion submission of your tax year 2024 tax year returns, and for those who owe money for that to be paid no later than April 15th, coming up just over 2 weeks from now. So I would say that given that the time deadline that we're facing, that one of the first things that taxpayers should be doing who have not already filed is to very, very quickly shift their priorities to collecting all of their income documents, their W-2s, 1099 forms, their other investment income forms, interest statements, dividend statements from stocks that they own, information about the income they receive from selling properties such as their home or business rentals, and or business income from running a business, hopefully at a profit. In addition, there should be a concerted effort and immediate effort to shift your priorities, folks, to collecting as many documents as you can, really proving that you have borne expenses in order to maintain the business. And if nothing else, during the next few days, collecting those documents, make sure that you've actually received the income documents, such as the 1099 or the W-2s, or those two primarily documents, that you've actually been able to get copies of those from your past employers, as well as being able to dredge up your bills, and the invoices showing that you have had to come out of your pocket to keep the business running. So at least you have the major items of paperwork that you need to complete the 1040 form and Schedule C business form and other types of business return forms. Because that time is upon us, the deadline remains April 15th, but there are some relaxation and some extensions of that, automatic extensions, because of the disasters. And I will try to keep you up to date on what states actually qualify, to file their tax returns later than April 15th. But to begin with, this year, the Republicans will be negotiating a whole new tax package, because, as you have heard, all of the special breaks and the increased standard deduction, particularly the huge increase in the child care credit, and the reduction in tax rates across the board, all of those things that were passed in the 2017 Tax Cuts and Job Act under President Trump's first administration, all of those expire at the end of 2025. So the federal legislature, the House and of Representatives and the Senate, have to negotiate a new tax package, because all of those special provisions that were passed in 2017, not all of them, but many of them that were passed in 2017 will be expiring. There are some of the changes that will not expire, but keep in mind that the Congress and business lobbying groups are pushing for an extension of many of those upgrades. One of the biggest ones, of course, is a child tax credit that was increased up to $2,000 per child. But keep in mind that Congress has and the IRS has come out with many qualifying requirements for even claiming the child tax credit. The major one being that the child has to be under the age of 17 at the end of the year. So it essentially means that they're 17 by on the last day of the year. They will no longer qualify for the child tax credit. They will qualify, however, if they're living under your roof for over half the year. and receiving other dependency benefits, they will qualify them for a credit, but it's so much less. It's only $500 as compared to $2,000 in the full child tax credit. The another major area has been the elimination of the 2% above the line, the 2% above the line deduction for miscellaneous expenses. 2% of the overall 2% rule that applied before the changes in 2017. That was all of those 2% of the miscellaneous itemized deductions. All of those were repealed in 2017. In addition, the state and local income taxes, which heretofore, before 2017 tax law, one could deduct on the Schedule A without restriction, but the 2017 tax law limited deducting those state and local income taxes to $10,000. And of course, folks in some of the more upper income states, felt a real significant blow to their tax write-offs, being limited to $10,000 on the Schedule A. So that has to all be renegotiated. In addition to those personal items, there's a good number of business write-offs. And you may or may not know about the 20% QBI, qualified business income write-offs, to self-employed people, independent contractors, farmers, some landlords, and owners of pass-through entities such as partnerships, LLCs, and S corporations. Some of those types of entities can claim that break on line 13 of the Form 1040. But this deduction ends at the end of 2025 unless Congress acts. And it was, as I mentioned, first enacted in the 2017 Tax Cuts and Jobs Act to provide some federal income tax parity between C corporations, which are taxed at 21%, and pass-through entities in which the individual owners pay income tax on earnings up to the 37% tax rate. The congressional Republicans want to make that 20% QBI deduction permanent, and they do have support from lobbying groups representing Main Street businesses. Some tax professional groups want that write-off expanded. For example, the American Institute of CPAs wants the specified service, trade, or business limit for upper incomers removed, or alternately, an increase in the monetary threshold. The lawmakers also want to fully restore three popular tax breaks for business: bonus depreciation. They're hoping to get those the depreciation, many of the popular depreciation measures restored. Prior to 2023, businesses could deduct the full cost of new and used qualifying assets with lives of 20 years or less. Now, the break is 40%, and next year it falls to 20%. Businesses, of course, want that 100% bonus depreciation revived. Research and development. Before 2022, firms could fully expense research and development costs in the year incurred. The Tax Cuts and Jobs Act of 2017 changes for tax years and started after 2021. And interest deductions on business debts of large companies. Well, the Tax Cuts and Jobs Act of 2017 limited a lot of big firms' net interest write-offs to 30% of adjusted taxable income, with the disallowed interest carried forward. So, I mean, that will be an area of a lot of attention. So those changes will be up for adjustment sometime during the year, and it's likely that it's going to take the full year to really foresee any real major changes in those tax laws, because of the huge amount of acrimony that already exists between the two major parties in Congress, and the still very, very present hatred of the current president, and efforts, even reaching civil disobedience, and the destruction of personal property. But because of all of the continued disagreement and lack of cooperation between the parties, is likely to take the entire year of 2025 to reach any agreement, bipartisan wise, on whether to restore those benefits from the 2017 tax law. So we will be reporting on any changes as that occurs. The keep in mind that there are changes in other areas, and one of those I might mention that has not been discussed much, and those involve retirees who are benefiting from the 2022 Secure 2.0 law. One of the major improvements in the retirement area is that the Secure 2.0 law does require high earners to put in catch-up contributions to the 401k programs and Roth 401ks. In 2025, in this current year, people who do have a 401k retirement program, who are age 50 and older, they can opt to put their catch-up payments into a pre-tax 401k account. They can put that into a tax Roth 401k, or a combination of the two. And that's provided that their employers offer the Roth savings option. Beginning in 2026, next year, employees who are 50 and older and whose annual compensation exceeds $145,000 can make up catch-up contributions only to a post-tax Roth 401k. The tax impact is that this will cut the upfront tax savings of those catch-ups for many employees who decide to max out their annual 401k contributions. In January, IRS proposed regulations that provide guidance to employers on how to interpret and implement this law. But there are two more secure 2.0 provisions that are slated to start next year. More people with disabilities can set up ABLE accounts. Presently, tax-advantaged ABLE accounts can be open only for individuals who become blind or disabled before reaching age 26. The Secure 2.0 legislation raises the age to 46. You can use $2,500 from 401ks to you can use those penalty free to pay for long-term care premiums. That's a new one. So you can take out some money up to $2,500 from your 401k and use that to pay for long-term care insurance. And it's well needed, because one of the biggest reasons most people don't carry long-term care insurance because of those premiums being so high. And if you are under age 59 and a half, the 401k distributions used for this purpose will not be hit with a 10% fine. So even if you go ahead and you're under age 59 and a half and you use the 401k distributions to pay for long-term care insurance, you won't be, there's an escape there. You will not be hit with a 10% fine. Keep in mind this year, folks, that for those of you who are in the higher income bracket, the annual gift tax exclusion is $19,000. For 2025, it went up to $19,000. For this year. So you can get in 2025, you can give up to $19,000 to each person without paying a gift tax, or tap in your lifetime estate and gift tax exemption, or even for filing a gift tax return. If your spouse agrees, you can get a gift up to $38,000 per donee. Going back to business taxes, a lot of buyers of business vehicles get generous income tax breaks in 2025 for new and used cars. That's a very, very, the bonus depreciation, if you use bonus depreciation, the first year limitation for a car that's first placed in service in 2025 is $20,200. So that's a very, very beneficial area of the tax law for businesses who buy vehicles that they use in their business, and that particularly applies to SUVs. Some things that you might want to be aware of if you had attempted to get a credit from the employee retention program. The IRS is continuing to have huge delays in processing claims, and that totally frustrates a lot of businesses, tax professionals, and the IRS National Taxpayer Advocates. This was a COVID-19 related federal payroll tax break, first enacted in 2020. It was designed to help eligible businesses whose operations whose operations were fully or partially halted, or whose gross receipts fell significantly during the height of the pandemic. Firms had been swamping the service with Forms 941X filings, seeking refunds for prior year employment taxes that they had paid and any excess refundable employee retention credits. IRS, after a very, very quick evaluation, decided that that particular tax break is just full of fraud, in large part because of shady promoters. It stopped processing refund claims in late 2023. Now, although the processing has restarted, a lot of businesses are still waiting for the service to process the refund claims. Believe it or not, 1.2 million employee retention credit refund claims remain unprocessed as of late October of last year. I mentioned earlier that that there has been a considerable breaks to folks who have disaster losses, in addition to delays in filing requirements. But some of the latest information under the disaster loss, coverage, expanded disaster loss relief really doesn't apply to victims of the 2025 California wildfire. That's based on language in IRS Publication 547 and instructions to Form 4684. In early December, Congress passed some easing up for personal disaster loss write-offs that were close to that given to victims of fairly declared disasters in 2018 to 2020. The rules let filers deduct losses from fairly declared disasters, even if they don't itemize. Items can deduct uninsured personal losses in excess to the $500 threshold without regard to the 10% of the adjusted gross income offset that generally applies. This qualified disaster loss is treated as an additional standard deduction. That's very, very, and when you first attempt to use the Schedule A, that's one area that it creates a lot of confusion. But just keep in mind that when you get into attempting to use the qualified disaster losses on a Schedule A, it's treated as an additional standard deduction. The language in Publication 547 and the instructions in Form 4684 gives additional information on using the qualified disasters as a write-off. Keep in mind that if you are claiming the earned income tax credit on your return, just keep in mind that is an automatic audit red flag. There's been a lot of errors involving the eligibility of the qualifying child. Of course, he or she must be a son, a daughter, stepchild, a foster child, sibling, niece, nephew, or grandchild who live with you for more than half the year and is under age 19. Now, there are two exceptions to the age requirement. Full-time students may be younger than 24, and permanently and totally disabled qualified children can be any age. In addition, each qualifying child that you claim for the earned income tax credit must have a Social Security number. The vast majority of, if not all, of the earned income tax credit audits are done via correspondence, meaning that IRS will send you a notice in the mail instructing you to respond back. The first round, so it's keep in mind that the earned income tax credit, while it is very, very lucrative and tempting to use, is extremely tightly controlled by IRS audits and audit activity. And another thing that this tax preparer has learned over the years, there are minimum, basic minimum thresholds that you must meet in order to qualify for the earned income tax credit. And people have been known, according to IRS audits, to inflate their income in order to meet the thresholds for these lucrative refunds that can be generated by earned income tax credits. So keep in mind that is an automatic red